Now we can start the substantial acquisition of shares and takeover regulations. So before the insider trading regulations, we are going to see the substantial acquisition of shares and takeover regulations first, because the reference of one term, like the term is open offer. The reference of the term open offer we will be seeing in the insider trading regulations, prohibition of insider trading regulations. So we have to first complete the open offer point. That open offer point is in the substantial acquisition of shares and takeover regulations only. So first we can do this, then we can go to the insider trading regulations. Now here if you see, what is the meaning of this regulation? First that I will tell you. Now here if you see, what is the meaning of substantial acquisition of shares and takeover? Substantial acquisition of shares and takeover. Now, takeover means we all know that we are going to take over the control of a company. The control of the company will shift. There is a shift in the control. From now on, the new person will control the company. That is the meaning of takeover. Then, when you see the substantial acquisition of shares, so we are buying a lot of shares of the company. Buying a high amount of shares. That is the meaning of substantial acquisition of shares. So what is the meaning? From here also, there might be a change in the control or significant influence you can exercise when you are purchasing a high amount of shares of the company. High amount means for now you can keep it as 25%, for example. 25% will be the value. High amount of shares, if you buy that, you will have a significant influence in the company. Now, control means you are taking over the company entirely. That is another thing. Now, here if you see, what will happen is that we are having one company. Now, that company is normally operating, there is no problem, nothing is having. This company is having its shares listed on a stock exchange. Now, some persons, either individually or as a group, they are purchasing the shares of the company slowly. Purchasing the shares slowly. Not in a single transaction, but they are purchasing small amount of shares on a continuous basis. They are doing multiple transactions, then they are slowly accumulating the shares of the company. Now suddenly after some months or after some 2 or 3 years, when you see these people, they are having about 40% of the share capital of the company that they are purchasing by the way of shares. Till now, they accumulated the shares by purchasing in small amounts on a continuous basis. Now, at the end, they are having 40% share capital of the company. Now, when you are investing in the company, what you will see? When you are investing in the company, you will see the financial statements. You will see the future of the company, whatever the projects they have acquired, whatever the tender they have acquired, and what is the demand for the product of this company in the future. And at last, you will see the management of the company. Who is the management of the company? Who is controlling the company? That you will see. If you have the trust in the management, only then you will invest the money, because this is the management are the persons who are going to run the company. So if they are good, they are having the potential. Only if they are having the potential to grow their company, the shareholders will get returns. So the management should be of persons who are having potential to grow the company. Now, management is one big reason why you are investing in any company. Now, suddenly if the management changes, suddenly the control changes, will you have the same trust in the company? That is the question. Management is one important reason. Suddenly it changes, and will you have the same trust? No, definitely not. Because the old management, they had the track record. They had all the prospects, and till now they only built the company to this level. Now, after this, what will be the future of the company? That depends on the management only. If that changes control immediately, then you will not have the same trust. You have to wait and see whether the new management is performing properly or not. So the trust will be lost. Now what will happen when the trust is lost? All the shareholders, they will try to sell the shares, or else they should be given an exit option. They bought the shares on the trust that the company will be under the control of the old management. Now the new management has come. They will all sell the shares. They should be given an exit option. They should be given an option to exit out of the company, because they don't like the new management. They dislike the new management. So this is one particular reason. Now, if 40% of shares are acquired these persons, and now these persons take over not take over, they can significantly influence, or they are going to control the company in any manner, because they are having 40%. together in an accumulated way. They are having it, so they can influence any decision of the company. Their voting is also required if you want to take any decision in the general meeting, or whatever the special resolution you want to pass, or ordinary resolution. Everywhere the consent of these shareholders is very important, these persons who have acquired the shares. Now the management has indirectly changed the control. Now these persons will also control the company because they are having a substantial amount of share capital. More than 25% they are having, 25% or more they are having it. So this will create a change in the control. Now for this, what we have to do? Now after doing this 40% of share capital, we have to give an exit option. What is the meaning of exit option? All the shareholders who do not like the control of these persons, they will give their shares, they will sell their shares, and then they will get their money. They will sell their shares, they will get the cash. Now for example, this is the company of Reliance. This is currently managed by Mukesh Ambani. He is a key managerial personnel we can take. Now he is the one controlling the company. Immediately we are getting Vijay Mallya. Now he is purchasing the shares of Reliance. Now he gets a substantial amount of share capital. Now all the people who are having shares in the company of Reliance, they will get a doubt. They will not have the trust. So they will try to sell the shares. This will crash the share of the company. This will reduce the share price of the company. So that's why we are having the regulations. According to the regulations, we will give the open offer. And in that open offer, all the shareholders who do not like the Vijay Mallya sitting in the management. Now, what they can do? They can sell their shares, they can get their cash. This will give an exit option for the shareholders who do not like the new management. So that is the entire philosophy of the substantial acquisition of shares and takeover regulations. Now, this is the meaning of open offer. The offer where where the shareholders who do not like the new management, they will offer their shares for sale. They will sell their shares to the new management. The Vijay Mallya, he will buy the shares sold by these shareholders, and he will settle the cash for the shareholders who want to exit. So that will be happening under the open offer. Now we can see here the persons who are acquiring, right, these persons, they will be called as acquirer plus person acting in concert. Acquirer means the person who is acquiring, that is plain meaning. Then person acting in concert means persons who are working with the acquirer with the same objective. Persons having the common objective with the acquirer. The common objective is to purchase the shares of the company and take over, or to take control of the company, or to influence the company. So that is the meaning of person acting in concert. These two persons, when they are together, they are getting some substantial amount of the capital. Then that will be a problem. For that, we have to give the open offer, exit option. Now here if you see, this is the open offer trigger point. When you have to give the open offer, we already saw that when you're having a substantial amount of shares, you have to give the open offer. When you're getting 25% or more of the shares, either by acquirer or along with the person acting in concert, you have to give the open offer. In the open offer, you have to allow the shareholders to sell their shares and get the cash. Now here if you see, the open offer trigger points, first point, acquirer plus person acting in concert, they are having 25% of voting rights. So they are having some shares. Because of that shares, they will get 25% voting rights. So here we are having we are not having the number of shares properly, but we are having the voting rights clearly defined. The such number of shares you should have such that you are getting 25% of the voting rights. Why we are having this voting rights point, not the direct share capital, is that we are having different types of shares. Normal shares we are having, differential voting rate shares we are having. So this we can also call it as the SR equity shares, superior rights equity shares. Like for example, normal shareholders, they will get one share, one vote. But the superior voting rate shareholder, they can fit it in any manner. For one share, they may get 100 votes. Or for one share, they may get 1000 votes. So like that, they may get different voting based on the SR equity share. So we are not taking the equity share number. We are taking the voting percentage, voting rights percentage. So 25% voting rights or more, such a number of shares, if it is there with the acquirer plus person acting in concert, they can buy it, but they have to give the open offer. Before buying it, they have to give the open offer. If you are going to buy 25% or more, first you have to give the public announcement, open offer, you have to give an exit option. After that, you can purchase 25%, there is no problem. They should need to make an open offer before acquiring such additional shares. So then acquirer along with person acting in concert, they are already having 25% or more. They are already having 25% or more. Now they want to acquire extra 5% voting rights. Shares for extra 5% voting rights. Additionally, they want to buy shares for extra 5% voting rights. Then also they have to give the open offer. So when they are doing the substantial acquisition 25%, and when they are additionally acquiring 5% in a at the same time, like 25 they are having, now they are slowly purchasing, they are purchasing extra 5%. Now, before touching the extra 5%, they have to give the open offer. So they have to give the open offer. After that only they can purchase the shares. That gives them additional 5% along with the existing 25%. Now this is a COVID relaxation that is not relevant. Now, if you are purchasing the shares as per a resolution plan under IBC 2016, after the completion of corporate insolvency resolution process, we will get a resolution plan approved by the NCLT. As per the resolution plan, if you are buying the shares, then that obligation is not there is exemption from this obligation. No need to follow this. Then explanation. So here you will take the gross acquisition. This 5% acquisition you are having, right? That you will take the total purchase. Even if you purchase 5% and you sell 2%, net when you see 3% only you have bought the shares. But we will not take this 2%, we will take the 5% only. You are trying to buy the 5%. Before buying that, you have to give the open offer. Then, if you are giving new shares, now the person already has 25% or more shares. Now you are giving new shares to him. Now what we will see is that what was the voting right before and what was the voting rights after. Now, this difference will be seen as the additional acquisition. This will be considered as the shares which you have additionally acquired. Then you have to give the open offer that we already saw. Now, we have to see the aggregate change. The change in the individual manner, not in the aggregate manner. So here if you see, for example, acquire we are having, person acting in concert we are having. So he had some, they both are holding 25%, there is no problem in that. Additionally, the acquirer had 3%, person acting in concert had 2%. Now here if you see, person acting in concert sold 2%, acquirer acquired 2%. Now total when you see, 25 is same, there is no problem in that. Here, now also 5 we are having, earlier also 3 plus 2, 5 we had. Now there is no change in the total shareholding when you see acquirer plus person acting in concert. But the change in the individual proportion, acquirer only had 3% earlier. Now he is having 5%. So in that case also this open offer will be triggered. Not only you should not only see the aggregate, you should see the individual proportion also. That also they have given. Then this will not apply to the acquisition by the promoter or shareholder in control. So already we are having some management. The current management, they are holding a majority number of share. Now, these people, if they are buying more share, buying additional share, which they have listed in the stock exchange, the people who are in management, they are buying the shares, then this regulation will not apply. So, we are not regulating the persons already in the management. We are regulating the persons who are new and they are trying to come into the management. They are trying to take over the company. They are trying to influence the company. We are regulating those persons. Then, if the company has listed the securities on innovators growth platform, so they have listed on the innovators growth platform, then the percentage, 25% or more we are having, right? That we have to see it as 49% or more. We will see 25% normally. If in innovators growth platform we are having shares listed, securities listed, then you have to see 49% or more. Then the open offer will trigger only when you are having 49% shares. When you are trying to acquire 49% voting rights. Then, acquisition of control. You shall not get the control without making the open offer. You have to make the open offer. What is the meaning of open offer? Here we are having one term called as the target company. The company in which the acquirer wants to take the control, that is called as the target company. So in the example we saw, this was the target company. Now that is the meaning of target company they have given here. In the target company, to the shareholders, to the existing shareholders of the target company, you have to give an offer. You have to give an offer to purchase the shares which are there with the existing shareholders and settle them cash at a particular price. Now the price and all will be determined as per the regulations only. Then this will provide an exit option as we already saw on account of the change in control. Then a voluntary open offer is an offer made by a person or acquirer plus person acting in concert. They are already holding 25% or more shares. They want to voluntarily give the open offer. They want to voluntarily give the open offer, acquire the shares of the existing shareholders, and they want to increase their voting rights percentage. For that, the persons can give voluntary open offer if they are already having 25% or more shares. Then, no need to wait for the 5% additional shares condition. They can give them voluntarily. They can give the open offer voluntarily. The price at which the shares will be purchased by the, what we can say, the acquirer plus person acting in concert, that will be called as the offer price. Then, if the offer price is decided and from the date of opening of the offer, we will have an offer period. We will have an offer period. During this period, the existing shareholders, they can offer their shares. If they do not like the new management or the change in control, they have to offer their shares. They have to tender their shares. Whoever tender their shares, it will be considered by the person. It will be considered by the acquirer plus person acting in concert. They will buy those shares. Now, when they are deciding the offer price and before the offer opening date, before 3 days, if you want to make any upward revision, you can do that. If you want to increase the price, earlier you decided 20 rupees per share, now you want to make it 25, then you can do it prior to 3 working days. That point also they have given here. Now, the next thing when you see director of the target company. Now, during the offer period we are having, right? Till now we have not purchased any shares of the shareholders. They have just given the offer. Now only slowly all the shareholders are coming and they are tendering the shares. They are offering their shares for purchase by the acquirer. So they are now only tendering the shares. Here what will happen is that in between the offer period, in the target company, whether the representative of the acquirer plus person acting in concert can they be appointed as the director in the target company? That is the question. Till now nothing has happened, just the open offer has started. After the completion of the entire process only you can give the representation in the board of directors. When you are appointing the representative of acquirer plus person acting in concert as a director, this means that you are transferring the control. You are putting such person in the board so that they can also view the operations, they can also give the influence, they can also influence the company's decisions. This should happen only after the completion of the open offer. During the open offer period you should not place any representative of the acquirer plus person acting in concert as the director in the target company. So I hope you understand this. Then and then you will give a detailed public statement. So here you will give a detailed public statement when you are doing the open offer, and from the date of detailed public statement you have to wait for 15 days. And after this 15 days you have to check whether the money is deposited or not. What money should be deposited? When you see we are having the open offer, in that we will be deciding the consideration. Totally this much shares we are going to buy, totally this much price we are going to pay, like totally 100 crores of the consideration, like that we are having the consideration. Now after 15 days from the detailed public statement, if the money is deposited, this money 100 crores, it should be deposited in a separate escrow account. That account is specially for the purpose of the substantial acquisition of shares and takeover regulations only. This amount when they deposit they cannot withdraw. This can be only used for the payment of consideration for the shareholders. Only for that purpose you can use it. That is the meaning of escrow account. It is a bank account. It is attached with a condition. So that is the meaning of escrow account, that you cannot withdraw. If you check that after 15 days from the detailed public statement, the money is properly deposited, then you can appoint the persons. So they have already deposited the money. Then you can appoint those persons representative as a director in the target company. There is no problem. Now the next point when you see, here in case of a conditional open offer, you cannot appoint any director. Here we saw that after depositing the money, we can appoint the director. That is in a normal case. Now we are having one more case, which is the conditional open offer. What is the meaning of conditional open offer? Here we are having the open offer, right? During the offer period, the shareholders will be tendering their shares. They will be offering their shares for acquisition by the person. Now there may be some conditions which may be imposed by the acquirer. The acquirer plus person acting in concert, they will give some conditions. What are the conditions? So they will say that approximately minimum 20% of the shareholders, they should offer their shares. Only then I will proceed with the open offer. Only then I will buy their shares. Minimum 20% of the shareholders, they should offer their shares for purchase. Only then the acquirer plus person acting in concert, they will acquire the shares. Like that they can give a condition. That is the meaning of a conditional open offer. This is the meaning of minimum level of acceptance. Minimum 20% of the shareholders, they should offer their shares for purchase. Only then the acquirer plus person acting in concert will buy the shares. So that is the meaning of minimum level of acceptance. And in this case, in any case, you should not appoint any director as the part of representing the acquirer plus person acting in concert. A person representing the acquirer plus person acting in concert, you cannot appoint them as director in any case. Even if you deposit more than the required amount in the bank account, it is not allowed. You should not represent. You should not represent in the board. You should not be appointed in the board. Now, when you see, no director should be introduced during the pendency of the competing offers. When two or three companies, two or three persons, two or three group of acquirers, group 1, group 2, group 3, they are having acquirer plus person acting in concert. They are giving competing offers. All the three people, they are trying to buy the company. They are giving competing offers. Then also you should not appoint any new director. Not even a normal director. Not as a representative. Any new director also you should not appoint. Then, if any director dies or there is an incapacitation or he vacates the office, then the vacancy will be done will be filled after the approval of the shareholders by postal ballot. The shareholders, existing shareholders, they have to give the approval by the postal ballot. After that only we will appoint the new director. Even if some director dies or he vacates the office, we will fill the vacancy only using this procedure. Then obligation of the acquirer. The persons who are acquiring and person acting in concert, they should be having firm financial arrangement. For paying the 100 crore consideration or the 1000 crore consideration, they should have made proper arrangement of funds. Then they have not declared any intention to alienate any material asset. Then they are debarred from alienating the asset. So, for example, we can see the target company is there. They are going to acquire the target company, the acquirer plus person acting in concert. Now they are having some key asset. Now that key asset, if the acquirer plus person acting in concert, if they are having the intention to sell, the purpose with which they are purchasing the target company is that their intention is to sell the key assets and then take the consideration. So that is their intention. For that only they are taking over the target company. Now, if they are having this intention, they have to declare it in the detailed public statement. Now, only if they declare after taking over the control of the company also, they will be allowed to sell the key assets. Now, if they are if they did not declare it in the detailed public statement, then even after taking absolute control of the target company, they cannot sell these key assets. They cannot alienate these key assets. They cannot dispose these key assets. That's what they have given here. Now, you should declare the intention in the detailed public statement to alienate the assets. Otherwise, you will be debarred from causing such alienation. You will not be able to sell it for a period of 2 years after the offer period. After the end of the offer period, 2 years, you cannot sell those assets. Then, even after that, you did not tell in the detailed public statement, but you want to sell. There is another way. Get the special resolution. Get the special resolution of the shareholders. Then you can do it. There is no problem. Then you have to make sure that whatever the details you give in the public announcement, detailed public statement, letter of offer, this is all you have to file it with SEBI and you have to publish it publicly. So these documents, they are having the true and adequate information, true and fair information. The acquirer shall not sell the shares during the offer period. During the offer period, the acquirer already they are having some shares right, that they should not sell it. Then the acquirer and person acting in concert are jointly and severally responsible. So if they want to pay the 100 crore, even if the acquirer does not pay, the person acting in concert, they have to pay the 100 crore. So they are jointly and severally responsible. Even if one person does not do, the other person has to fulfill it. Then obligation of the target company. The target company, what they have to do? They have to do the business normally. There should be no change in the normal course of the business. It should be conducted normally. Then the board of directors shall not alienate any material assets or affect any material borrowings after the open offer has been announced or after the things have been started. During the open offer period we are having, during the open offer period, the already existing board of directors, the current management, they cannot get any new borrowings, material borrowings. They can get normal small borrowings in the ordinary course of business. That is not a problem. But any material new borrowings, a large amount, they cannot borrow immediately during the offer period. They cannot sell any key assets. Then they cannot issue the unissued securities. They cannot issue a new securities. Issuing new securities is not possible, but you can give the conversion of securities. Already 10 years back, you issued some convertible debenture. Now the conversion due date, the due date of conversion of the debentures into equity shares, it falls in the open offer period. That you can do. There is no problem like that. Some things we are having. Already you have filed the red herring prospectus. Already before the open offer starts, you have filed it. Or you have announced the record date of the right issue before the public announcement. Then and all, there is no problem. You can do the issue of shares. But normally, issue of shares is not allowed. Issue of securities itself is not allowed when you are in the open offer period. Then they cannot do the buyback of shares, they cannot amend or they cannot close down the key contract of the company, then they cannot accelerate any contingent vesting, though, so that and all we are having. Then, in the general meeting of the subsidiary of the target company in respect of the matter related to sub-regulation 2, these matter we are having, right? This target company that we are having. Now, this target company, some cases, the target company might not have the value. This target company is the holding company of one subsidiary. That subsidiary is the main valuable company. Now, for for taking control of this subsidiary only, the acquirer plus person acting in concert, they are trying to take control of the target company. If they control the target company, automatically they can control the subsidiary. So now the subsidiary, for example, we can take it as having some material contract, or it is having some asset, or it is having some other thing which is very valuable. So for that purpose only, they are trying to purchase the company. They are trying to take over the control of the company. Now we have seen that the target company might have value, but in some cases, the subsidiary of the target company will be the most valuable item. it will have some valuable asset or valuable contract, something will be there with the subsidiary. So for acquiring the subsidiary only, the acquirer plus person acting in concert, they will try to take control of the target company. Now we have to see one example here so that you can understand this properly. Now here, for example, we can take one target company and we are having a subsidiary. This subsidiary is having one warehouse, and it is a very big warehouse which is of a lot of worth. It is a high worth asset. Now the target company is the holding company. Now the management of the target company, they want to sell the warehouse. The management of the target company, they want to sell the warehouse. All this is happening during the offer period. The offer period is going on. Now they want to sell the warehouse. They cannot sell it. They have to get the special resolution of the target company shareholders by passing the special resolution through postal ballot. Special resolution through postal ballot is needed. Now what they will do? The target company, it will conduct a general meeting. It will conduct a extraordinary general meeting. And what it will do? It will get the approval through postal ballot. Now the outcome of the resolution, whether the SR is passed or SR is not passed. Now, if SR is passed, that is one outcome. If SR is not passed, that is one outcome. Now, for example, we can take SR is not passed. Then what will happen? The subsidiary will call a general meeting. In the general meeting, the parent company, the target company only is holding the share. The target company only is holding the share. So what will happen? The target company has to vote whether they will sell the warehouse or not. Here, the shareholders of the target company, they told that SR not passed, so they cannot sell the warehouse. This means that they cannot sell the item. Now here, target company, when it is voting in the extraordinary general meeting of the subsidiary, now what they have to vote? They have to vote we should not sell the warehouse. Like that only we have to vote. The vote done by the target company in the general meeting of the subsidiary, that should be the same as the resolution passed by the shareholders of the target company. That is what they are saying. So just this example is enough, no need to go any deeper into this. Now this is this point. Then prohibition from fixing a record date. The target company cannot fix any record date after the third working day prior to the commencement of the tendering period and until the expiry of the tendering period. During the tendering period, the offer period, you cannot fix the record date. Not only during the offer period is starting here. The 3 working days prior to that. In these 3 days also, you cannot fix the record date. Record date for any item, you cannot fix it in this time period. Then the next thing, furnishing the list of the shareholders. Now, within 2 working days from the identified date, the list of shareholders should be given to the particular acquirer plus person acting in concert. So what is identified date they have given here that you can read it. The list of the shareholders must reach the acquirer plus person acting in concert. Then the reasonable cost for sending the list of shareholders, it will be paid by the acquirer plus person acting in concert. Then the next point is, here what will happen is that after everything is done, before the open offer period starts, the target company will form a committee. In that committee, only independent director will be there. They will decide whether the thing is correct or not, whether the open offer, whether it is proper or not. Whether it is proper or not, that will be evaluated by the independent director committee. They will give the recommendation to the target company, whether they have to accept it or not. Those things will be given by the independent director committee to the target company. That will be happening before the open offer period starting, before the beginning of the open offer period. So that they have given here. Then duties of the committee. The committee, what they will do? They will provide the proper recommendation on the open offer along with the reason why they are giving the recommendation. That reason also should be there. That will be published at least 2 working days before the commencement of the open offer period. 2 working days before the open offer period, it should be published. Then the copy of that particular recommendations, this committee report, that will be given to the board and then the stock exchange and then manager of the open offer. Then if there is competing offer, to the manager of every competing offer. Then verification of shares. The shares should be verified. Whatever the shares that were tendered, the shares that were offered for the sale in the offer period, that should be verified, whether the owner is proper or not, whether any problem is there in the title of the shares, that all should be verified properly. The next point is providing of information to the acquirers. Now, for example, we are taking three competing offers. Offer number one, we are having offer number two, offer number three. Now, all these three people have given the competing offers. These are all the acquirers. Three different acquirers. Now they have given the offers. Here, the company, if it is the target company, if it is giving the information to one acquirer, that information should be shared with the other two acquirer also. You cannot partially or with partiality, you can give the information with just only one acquirer. If you are giving the information related to the company to one acquirer, it should be shared with the other acquirers also. Then, after all the conditions followed, after everything completed, you have to register the transfer of shares. The shares should be transferred to the acquirer properly. Then, what is the manager of the open offer? There will be a manager to the open offer, and what are the obligations of the manager? So, the manager will make sure that the acquirer is able to implement the open offer and firm arrangement for funds. The 100 crore or 1000 crore, we have to make payment right to the shareholders of the persons, shareholders of the shares offered. So that payment, whether it is properly arranged or not, the funds arrangement, that should be checked by the manager of the open offer. Then the manager should ensure that all the detailed public statement, public announcement, everything is properly given. All the information given are true and fair. Then the manager should give a due diligence certificate along with a draft letter of offer to the board. So here board means SEBI. Due diligence certificate should be filed with the SEBI by the manager. The manager should ensure that the intermediaries, the stockbroker, sub-broker, whoever is engaged in the transaction, in the open offer, whether they are registered with the SEBI or not. Then they have to exercise diligence, care, professional judgment, normal point only. Then they should not deal in the own account. They will have the insider information and all. They should not buy the shares, sell the shares, that they should not do on their own account. They shall file a report on the board. The manager should file a report on the board confirming the status of completion of various open offer requirement. The requirement under this regulation, whether they followed it properly or not. That after the open offer, the manager should file a report to the SEBI. These are the obligation of the manager to the open offer. Then disclosure of shareholding and control. And whenever you are getting the shares, whenever you are purchasing the shares, you have to give the disclosure also. So who should give the disclosure? What should be the disclosure? So here the aggregated shareholding of the and voting rights of the acquirer or promoter or every person acting in concert. That should be given as a disclosure. The total shareholding which is and voting rights held by the acquirer, promoter and the every person acting in concert. The acquisition and holding of convertible security will also be treated as shares. If you are having a compulsorily convertible debenture, compulsorily convertible preference share, these two will be considered as equity share only. Then here encumbrance. Here we will be having the disclosure of encumbrance. When you are pledging the shares, that information also you have to report it in a separate form. So encumbrance means what you can say when you are pledging or hypothecating or mortgaging, everything will be called as an encumbrance. It is a charge on the asset. When you do not pay the loan properly, the assets will be sold by the pledgee. So the assets, the shares will be sold by the lender. So that is the meaning of encumbrance. That definition they have given here, that you can read it. Next, threshold for disclosure. Now, acquirer along with person acting in concert, if they are acquiring the shares or voting rights, aggregates to 5% or more of the shares of such target company, they shall disclose their shareholding. So here when you see, we saw that when you are getting 25% share or voting rights, you have to give the open offer. But we will not wait till 25%. You initially, when you are having 0%, now you are acquiring, slowly you are acquiring and 5% you got. You reached a 5% shareholding. Now here also you have to give a disclosure. Disclosure of your aggregate shareholding. So 25% you have to give the open offer. So slowly from 0 to 5% when you reach, in that case itself you have to give the disclosure of aggregate shareholding. So aggregates to 5% or more. Then in case of changing shareholding or voting rights, you are having 5% or more shareholding now. Now you are going to do some transaction, you are going to purchase the shares or you are going to sell the shares. Then in that case, you will be having a change in the shareholding and voting rights. Your voting rights will change. That also you have to give the disclosure. So you are having 5% or more shareholding currently. Now you are doing some change. You are purchasing the shares or selling the shares. The change is 2% or more. Then you have to give the disclosure according to the regulations. Disclosure you have to give in this point. When 2% or more change is there in the shareholding, already you are having 5% or more. The change is 2% or more. So that point they have given here. If the share is listed on an innovator's growth platform, then 5% will become 10% and 2% will be becoming 5%. So here we saw, right, when you are getting 5% share, you have to give the disclosure. That will become 10% for the innovator growth platform shares, and 2% we saw, right, that will become 5%. So that also they have given here. Next point, when you see the disclosure, you have to give it within 2 working days from the receipt of allotment, intimation of allotment of shares. The intimation of allotment, you have got the shares allotted for this transaction, for purchasing a 5% or purchasing the first 5% or change in the 2%. That disclosure you have to give, right. That should be done within 2 working days of the allotment of the share to the stock exchange and to the target company at the registered office. Now the next point, when you see shares taken by way of encumbrance is treated as an acquisition. Shares given upon release of encumbrance shall be treated as a disposal. Now I will tell you simply what it is. Here we are having the owner of the shares. Now he is pledging the shares with the lender. Now what will happen? The shares will go to the lender and then the loan will be received by the owner. Now this will be treated as an acquisition for the lender because the shares are going to him. Now after repayment, what will happen? Now after repayment, the owner will get the shares back and then the loan will be repaid to the lender. Now from the lender, the shares are going outside. So for lender, this will be treated as a disposal of shares. And this will not be applicable to the banking financial institutions that they have given here, like that. Not apply to a scheduled commercial bank. Those points they have given here. Then when you're pledging the shares also, you have to give the disclosure. Like when the promoter of the target company is pledging the shares, then they have to give the disclosure. Then they have to disclose the details of such invocation of such encumbrance. When the encumbrance is forced, you are unable to pay the loan and the shares are sold by the lender, then in that case, that is called as the invocation of encumbrance. You are enforcing the charge on the asset. That also will be disclosed by the promoter. After that, the disclosure will be 7 working days time period from the date of creation of charge or invocation of charge or release of charge to the stock exchange and the target company. Then yearly, every year you have to give an annual declaration also. Annual declaration that you have not made any encumbrance other than the ones declared earlier. When you are making the encumbrance itself, you should make the disclosure. Other than that, annually you have to give one declaration that other than the ones reported, there is not any other encumbrance. Then for the annual declaration also, 7 working days is the time limit. You have to give the annual declaration to the stock exchange, and here you have to give it to the audit committee. So that's all about this regulation. You have completed everything. Just now I will just give you one overview of the entire open offer process. Here some points will be there that are not there in the not given in detail in the regulations and the ICAI study material also. But I am giving an overall view of what will happen in the open offer process. So first point is trigger point. The trigger point of the open offer we saw. What are all the trigger points? So here if you see from the first, when you see, you will get the 3 trigger points. So here, when you're getting 25% or more of the voting rights, you have to give the open offer. Then, after having 25% voting rights, additionally you are purchasing 5% voting rights. Then also you have to give the open offer. Here, when you see, we are having one regulation. Before acquiring the control, when you are going to acquire the control of the target company, before that you have to give the open offer. So 3 trigger points: 25% voting rights acquisition, 5% additional acquisition, and then the acquiring control of target company. Before doing these actions, you should give the open offer. So what will happen in the open offer? You have to first give the public announcement, like the trigger point has reached and we are going to do the open offer process. That public announcement will be given. After that, you have to estimate the not estimation, you have to give the maximum amount. What is the maximum amount that might be payable under the open offer process? That you have to calculate and deposit it in a escrow account. Escrow account, as we already saw, it is an account with a condition. For that purpose only you can use the amount, or after the process completed you can withdraw the amount. So that escrow account you have to deposit the amount. How to calculate the amount to be deposited, that all is not there in the syllabus, so that is not required for us. Next, the detailed public statement. Along with that, you have to give the detailed public statement also. After that, the draft letter of offer. The draft letter of offer will be filed with the SEBI. Who will file it? The merchant banker. The merchant banker will file the draft letter of offer. Then the SEBI will review it, they will give the observation, and then they will give the approval. After the approval of SEBI, you have to dispatch the final letter of offer to the shareholders. In this final letter of offer only, they will give the details, like when the offer period will start, who can give the who are eligible to give the offering, who give the shares for offer. Then those details will be there in the final letter of offer. All the details for the shareholders will be there in the final letter of offer. After that, we will conduct the independent directors committee meeting and all. Then the recommendations will be given by the independent director committee. Recent recommendations about the open offer, we saw that regulation also. After that, the open offer period will start. The open offer period will be exactly for 10 working days. It will be open for 10 working days. After that, it will be ending. Then, after completing the offer period, we will give the post-offer advertisement. Like we conducted the open offer. In the open offer period, this much shares were offered by the shareholders, and we accepted this much shares. That all you have to give the information. After that, final settlement will happen. The payment will be credited to the shareholders who offered the shares and accepted. Here, when you see, for this we are having the timeline also, but I am not going to complicate by adding the timelines and all. Just this is an overview of the open offer process, so that you can understand it well. So other than that, whatever the points given here, that you, if you remember, that will be okay. The open offer trigger points. The open offer trigger points we saw, right? That is an important topic. After that, in this chapter, when you see the obligation here, this itself is a very small chapter only. So from anywhere they can ask the question. So that's all. You have to read this entire chapter fully. That's all about the substantial acquisition and takeover of shares regulations. Substantial acquisition of shares and takeover regulations. Now we can start the insider trading regulations. So here if you see prohibition of insider trading regulations. So the word prohibition appears in the title. So this means that you should not do the insider trading. Insider trading is a very wrong thing and you should not do it. Here, who's an insider? Insider trading should first know who's an insider. So insider will be a connected person or a person who's having unpublished price sensitive information. So, what is the meaning of unpublished price sensitive information? We are having some kind of an information. That information might be about the financial statements of the company, or might be related to some fraud that is happening inside the company, or related to some loss that has been happened to the company, or related to some kind of an issue that is going on in the company. These are all the issues that are going inside the company. This information, if it is released in the public, it will affect the price of the share. It will affect the price of the share in the stock market. So this kind of information are called as unpublished price sensitive information. So these are unpublished, meaning that it is still not released to the public. Price sensitive means when this information is released, it will cause a change in the price of the share. So whether it may be a positive change or it may be a negative change, but there will be a change in the price of the share. So this is the meaning of unpublished price sensitive information. If you are having such information, then you are also called as an insider. For a particular company, you will be called as an insider. So here if you see connected person having unpublished price sensitive information, those people will come under insider. And any person who's having access to UPSI, definitely they are not having it, but if they want, they can go and get the UPSI. Within the reach, they are having the UPSI. So they will also be considered as an insider. So here when you see what is the meaning of connected person, we saw who is a person having UPSI. This unpublished price sensitive information will be called as UPSI in short. Now, what is the meaning of connected person? Here connected person, when you see, for example, we are doing a transaction. We are doing a transaction on this date. Now you have to check whether you are an insider or not. For that you have to check whether you are coming under the definition of connected person or not. So who's the connected person? 6 months prior to the concerned act. 6 months prior to the transaction, you have to see whether you are connected with the company. How you will be connected with the company in any capacity, like you are a director, officer, employee, or you are under any capacity working in the company, or you are in a contract with the company, you are in a fiduciary capacity, in a trustworthy capacity, you are in an employment relationship, you are having frequent communication with the company or the officers, and you are having access to the UPSI, or you are reasonably expected to allow such access. So either you are having the UPSI, then also you will come under connected person. As because of your relationship with the company, you are having UPSI, you are handling UPSI, you will be a connected person. In another case, you are expected to access the UPSI. For example, you are a CEO of the company. You cannot say that I will not have any UPSI. Like that, you cannot say. Obviously, you will have the UPSI. You are reasonably expected to have the UPSI. So that is the thing. Next, along with the generality, this is a general definition. Anyone who's there in the relationship with the company, they will be covered under this definition. After that, we are having some specific people, like relative of the connected person above. If you are a connected person under this point, then your relatives also will be connected persons. Then holding company, associate company, or subsidiary company, intermediary in section 12 of the Act, SEBI Act, like the stockbroker, sub-broker, those people, investment company, trustee company, official of a stock exchange, member of a board of trustees of a mutual fund, then member of board of directors for an employee of the public financial institution, then self-regulatory organization, banker. Those people are the professional firms and then the other institutions, financial institutions and other what we can say intermediaries who are working with the company. They will know the financial information of the company, which are the unpublished price sensitive information. So these people will always handle the UPSI. So they will always be connected person in relation to a company. So that we saw what is the meaning of connected person. Now, what is the meaning of generally available information? It is the information that has been released to public, that is verified, and there is no problem in that. Everyone knows that it is on a non-discriminatory basis. Each and everyone knows that. So that is generally available information. And if there is some unverified information, main point is the information should be verified. If there is an unverified information going on in the social media, that will not come under the generally available information. Then unpublished price sensitive information. What are all the main points? Like financial result will be the UPSI, dividend declaration, change in capital structure. You are going to get loan. You are going to issue shares. Everything will come under the UPSI. Merger, demerger, amalgamation, delisting, key managerial personnel changes. You are firing the CEO. You are creating a new CFO. Those people, those changes in the position will also come under the UBSI. Then when you see fundraising, change in the rating, like every company will have a debt rating. The bonds issued by the company, it will contain a rating. Credit rating by the credit rating agencies, that rating. Then fraud or default in the company, agreement done with the company, resolution plan that is going to be implemented in the company, admission of the winding up petition. You are going to do a petition for winding up. That petition admitted. Then initiation of forensic audit, outcome of any litigation, giving any guarantee, withdrawal of any license. You are working in an industry where you have to get the license from the government authority. The government authority has withdrawn the license. The license is cancelled. Without having a license, you cannot work. So that license cancellation is a very important event which will be a part of a UPSI. Now the next thing when you see, these are all the things coming under UPSI, just you can give a reading. So when you spot a UPSI, you will be definitely knowing that it is UPSI. So that kind of information only UPSI is. Now we saw what is UPSI. Then what we have to see is that UPSI, we should not trade with it. Why we should not trade with it? That logic you need to understand. For example, you are working in the company, you are an employee. You are an employee in the finance department, like that we can keep. In finance department, you know all the information. What is the loan got by the company? What is the guarantee given by the company? What is the agreement signed by the company? What is the contract entered into by the company? And what are the financial results? Everything will be known by the employees. So you know all these information. Now, based on this, you can judge that whether the share price will go up or it will come down when this particular information is released in the market. Till now, these information are not released to the public. Now, for example, if it is going to be released on 10th of any month, but you are currently on the 2nd of the month. Now you know that after the release of the information, the share price will go up. Currently the share price is 100. After releasing the information, it will become 200. You know this. Now what you will do? You will use your own funds and you will buy some 1000 shares. It will be for a purchase cost of 1 lakh rupees. Now after releasing the information, the share price will become 200. So the value of the 1000 shares will become 2 lakh. Then you will sell the shares, you will have the 1 lakh profit. 1 lakh you will get the profit. But this is very wrong because normal people, they do not have this information. You are having this information because you are an insider. You are working in the company. So this creates an unfair advantage. So this unfair advantage should not be there. Because of that, we should not do the insider trading. That is the only thing here. I hope you all know this. So I am just telling you a brief explanation here. So everyone knows why we should not do insider trading. So the next thing when you see, you should not communicate the UPSI. You are having the sensitive information, UPSI. You should not communicate it to anyone. You should not spread it. Then you should not procure the UPSI. You should not try to obtain UPSI so that you can trade with UPSI. So you should not try to obtain the UPSI. Then for legitimate purpose, you can use it. There is no problem. Here also, except when it is done for legitimate purpose or performance of duties or discharge of legal obligation. Legitimate purpose, discharge of duties and discharge of legal obligation. For these purpose, you can communicate the UPSI. But for other purpose, you should not do it. So what is a legitimate purpose? For that, the board of directors of each company, they will create a policy. For these purpose, you can do it. There is no problem. That will be covered under the legitimate purpose. That detailed policy will be released by board. Based on that, you have to communicate and handle the UPSI. Then, when you see insider, if UPSI is accessed, so this means that you are not an employee or not in any relationship with the company, but you are getting to know the UPSI. You did not try to obtain that also. Accidentally, you got to know about UPSI. You got to know about UPSI. Then you will become an insider. All the regulations in this particular prohibition of insider trading regulations will apply to you. You should not trade with the shares using the information. You should not communicate it to any other person. That and all will be followed by you also. You should follow that. Then open offer. So we already saw in the regulations, like the substantial acquisition of shares and takeover regulations, that we have to do the open offer. According to these regulations, when you're doing the open offer, the acquirer plus person acting in concert, they might need some information about the company. because they are going to acquire the shares. They need some information about the company. For this purpose, if it is needed, the board of directors can decide and they will allow the UPSI. They will communicate the UPSI to the acquirer plus person acting in concert. So this is the thing. According to this regulation, we are doing the open offer. The board of directors decide that the UPSI communication is in the best interest of the company. It is good for the company. It is the requirement. Then they will communicate it to the acquirer plus person acting in concert when there is a open offer requirement. Then in other cases, we are not having the open offer requirement. Open offer and all, it is not there. But the board of director, they decide that it is proper and it is in the best interest of the company. What is in the best interest? To communicate the UPSI. Then after using that decision, they can communicate the UPSI. When it is required for the transaction or something like that, they can communicate. There is no problem. For trading and other illegal purpose, for insider trading, you should not do that. So those 2 points are given here. So here, next point, when you see confidentiality agreement. So we saw that when you are getting an open offer, or in other cases, you can communicate the UPSI when the board of directors has taken the decision. When you are communicating in that manner, you have to execute the confidentiality agreement. Like, this is the insider information, we are going to receive it. We will not do the trading based on that. We will follow all the insider trading regulations. We will not communicate it to any other person. We will not use it for illegal purpose. So like that, you have to get the confidentiality agreement signed. You should execute the confidentiality agreement. After that only you have to share the UPSI. Then for the persons to whom you are sharing the UPSI you will share with many persons. To the banker, financial institution, open offer, that person, and then any other contract you are doing, to government, everywhere you will share the UPSI. You should maintain a structured digital database. Structured digital database along with the identifier. So for any person you are giving the UPSI, you have to get the name, details, along with the PAN number of the person who is receiving the information. That details should be there in the structured digital database. It should be maintained internally. Internally means everything, the server, everything should be maintained internally. If you are giving it to third party server, it is not allowed. You should maintain the server internally. It should be done properly by the company itself. It should not be given to any other person outside. They cannot outsource it to any other person. Then the entry in that information. So structured digital database, that is within the company, you are going to enter the information into that. Now if the information is passed from within the company, that information is going outside, then you can easily enter it, the database also within the company only, and then the company also, they know what information is there, they will enter it quickly. But some information, it is arising out of the company from other party. For example, you are doing a contract with some other company, you are the what we can say, the obligated company. For example, your company is doing, we can take partnership firm, your company is doing contract with the partnership firm. Now the partnership firm has given the approval for some agreement we are going to do with the partnership firm for some contract. Now this approval, they have got it, that is a part of the UPSI only. Now this information, it is arising from the outside. This you have to enter it into the structured digital database if you are procuring it, if you are communicating it to someone. So for that you are having 2 days, 2 working days, within that you have to enter this UPSI into the database. So 2 calendar days from the receipt of the information, you have to enter it within the structured digital database. Then the structured digital database, it is applicable to the listed companies, intermediaries and fiduciaries. So listed company, they should maintain it. Intermediary, the stockbroker, sub-broker, investment advisor, research analyst, those people also should maintain the database. To what persons they are communicating the information. Fiduciaries, like trustee, those people who are handling the information in a trustworthy capacity, they also should maintain the structured digital database. Then listed company will, what it will record, the nature of the UPSI, what kind of UPSI it is, then details of the sender, receiver, then PAN number should be there. If it is not available, any other unique identifier you can do. That also you have to record it in the database. Intermediary or fiduciary, he should record the UPSI received or shared, details of the company, regarding which company this UPSI is there, then details of the sender, receiver, everything should be there by the recorded by the intermediary and then the fiduciary also in their particular respective database. The database provided by third-party vendor is not allowed. Then the records shall be updated in the digital database as and when the information gets transmitted. Then preserved for 8 years. The structured digital database, you have to preserve it for 8 years from the completion of the 11th transaction. Then the preservation timeline is very important. They may ask it in MCQ, in SETI or IBS. So 8 years is the preservation timeline. Then trading when in possession of UPSI. When you are having the UPSI, you should not do the trading in the securities. So you should not do trading when you are having the UPSI. Now, the next thing is you should not trade in the securities when you are having the UPSI. But in some cases, you can trade. What are all the cases? The transaction is an off-market transfer between insiders who were in possession of the same UPSI. So, for normal people only, it will be an unfair advantage. But when you are an insider, you are going to do the trade. The other person is also the insider. Both the insider, they know the UPSI. Then there is no problem. They are doing the trade in the off-market terms, off-market transfer. They are doing it as a part of a off-market transfer. They are not doing it in the market. Other than the market, separately they are doing the transfer between two insiders who are having the same UPSI. Then no problem. There is no unfair advantage. Both are on the same ground. So that point is there. That is an exception. Then transaction was carried out through the block deal window mechanism. As per the block deal window mechanism, in that if you are doing some kind of a trading, the transaction, then also it is allowed. After that, it is done in pursuant to a statutory or regulatory obligation. For a bona fide transaction, you are doing a bona fide transaction. That is a genuine transaction you are doing. That also you are doing based on the statutory requirement. According to law, you are having a requirement. Based on that only you are doing the transaction. You are not doing it out of your own wish. Then in pursuant to exercise of stock option in respect of which exercise price was predetermined. So stock option, it will be given to the employees and other people, right? The stock option you are exercising. You are exercising the stock option and then the price was predetermined. The price at which the stock will be issued, that is predetermined. Already it was determined earlier. Then in that case you can do the thing. There is no problem. You can exercise the share option. Then non-individual insider. When the insider is a entity like they are a company or a partnership firm or a trust like that, they are some insider, they are having the UPSI. Then persons in the company, there will be people working normally, and then some people might be there, they are handling the UPSI information. Now these two people are there. Now the person who are doing the trading, who's taking the trading decision, that should be from the normal people. The UPSO information, the people who are handling the UPSO information working inside the company, that group of people, they should not take the trading decision and all. The normal people who do not have the UPSO information, they should take the trading decision. For that, you have to keep a proper controls that and all should be there. So that they have given here that point. Then you are doing the trading as per the trading plan. The trading plan, what is the meaning of trading plan? We will see it later. This point is the trading plan point. We are having a separate discussion for that. Then here you are having the UPSI, you did the trade. Then we found out that the SEBI or some investigative agency or someone found out that. Then what will happen is that they will assume that you did the trade because you had the UPSI and you saw some advantage. Because of that advantage only you are doing the trade. You are doing it for wrong purpose. That will be the assumption. Normally when you are trading with UPSI, that will be the assumption. That point also they have given here. Then if you are a connected person, you are doing a trade and some complaint is there or SEBI is doing an investigation, then they found out that you are a connected person and you did a trade. Then you have to prove, the connected person has to prove that he did not trade. He did not trade on the basis of UPSI. That should be proved by the connected person. Connected person only should give the proof that I traded on this time, I did not have the UPSI, or I traded but I did not trade it on the basis of UPSI. That all should be proved by the connected person. But in case of other person, if there is any other person on whom an insider trading allegation is there, then SEBI only should prove that the person did the trade based on the UPSI. That should be proved by the SEBI. When you are a connected person, you have to prove that you are innocent. When the case is on other persons, SEBI has to prove that the person is guilty. So that concept also they have given here. Bonus of possessing the UPSI. Then the board may give such other condition requirement and all that also they are having the power. Then we can see what is the meaning of trading plan. Some people they will always have the UPSI. They will always have the UPSI, like the CEO of the company, the CFO of the company, or the employees of the company, all the connected persons you can take. Those people will always have the UPSI. So whether they are banned from trading, that is the question here. Whether they cannot even trade in their lifetime, whether that is a question here now. Now the answer is no. They are not banned from trading. They can do the trading, but they have to do it as per the trading plan. What is a trading plan? Trading plan means it is a proper plan where you will tell all the information like I am going to buy the securities or I am going to sell the securities. I am going to do it on this date and then the price range. The price range means if the price goes between this range, I will do the buy transaction. If the price goes in this range, I will do the sell transaction. That everything will be there in the plan. That will be called as the trading plan. That trading plan you have to prepare it. All the persons who are always in the position of UPSI, who will always handle UPSI, they should prepare the trading plan. They will give it to the complaints officer of the company. The complaints officer will check that, he will verify that, and then he will approve it. Based on his approval, you can do the trading as per the trading plan. And after creating the trading plan, it is mandatory to follow the trading plan. You have to compulsorily follow the trading plan. If you are not following, you have to do separate procedure for that. You have to intimate to the complaints officer. They will do the discussion on that. Why you did not do that? Everything will be done afterwards. But it is mandatory normally when you are doing a trading plan. So whenever the person who's always having UPSI, they should do the trade only as per the trading plan. So that points they have given here. The trading plan should be prepared by the person. They should present it to the complaints officer. It should also be disclosed to the public. It should also be declared to the public that this is the person they are going to do the trade. That and all they will be giving it to the public also. Then, so this trading plan, one more important point we missed out. So here, the person will always be having UPSI, right? The UPSI that was there with the person when they were formulating the trading plan. When they created the trading plan, they will have some UPSI. This trading plan, you have to start the execution of the trading plan only after this UPSI is released. So, at the time of formulation of trading plan, some UPSI will be there with the person. The trading plan should be starting only after such UPSI is released to the public. So, that is one more point. Then, when you are doing the trading plan also, you should not use it for market abuse. You can do the trading plan, it is a relaxation given to you. You should not use it for market abuse. That is also one more point. So here when you see that point they have given here, the UPSI should be released. UPSI that was there with the person at the time of formulating the trading plan. Formulation of such plan. Then the trading plan shall start after 120 days of public disclosure. You are preparing the plan, getting the complaints officer approval, everything you are doing after the public disclosure. You are doing the public disclosure. After that, you have to wait 120 days. After 120 days only, you can start the trading plan operations. Why that 120 days wait? In that 120 days, all the UPSI that were there with you at the time of formulation of trading plan, that will get released properly. Normally, it will get released. Any UPSI, it will be released in 120 days. Financial result, dividend, everything will be released. But if it is not released also, you should not start the trading plan till the UPSI is properly released to the public. So that is the restriction we are having here. Then cannot overlap any other trading plan already in existence. If you are already having one trading plan for this time period, you cannot keep another trading plan for this time period. That is not allowed. Only one trading plan at one time period. Then the following information should be there. Value of the trade, how much amount you are going to trade, what is the number of securities you are going to trade, nature of the trade, buy transaction, sell transaction, specific date or time period, not exceeding 5 consecutive days. So the time period between this 10th and then the 20th, I will do the trading, like that you can give the range. But the time period should be maximum 5 trading days. Then price limit. For a buy trade, the upper price limit. For a sell trade, the lower price limit. So buy trade means, for example, I am trying to buy the shares. But I will keep an exception that if the share price reaches 1000 rupees, I will not buy. When you are selling the shares also, you can keep an exception. If the share price reaches 800 rupees, I will not sell. Below this, I will not sell. Above this, I will not buy. So like that, you can keep an exception. That information also you should be telling in the particular trading plan. Then details of 1, 2 and 3. Value of trade, nature of trade, date and time period. It is mandatory. Fourth point is optional. Then you should not do the trade for market abuse. Then the complaints officer will review the trading plan. After that, he will approve it. Whether there is any potential for violation, everything will be checked by the complaints officer only. Then after getting the approval of the trading plan, no need to go to complaints officer for getting approval for each and every trade transaction. Once you get the approval, you can do the transaction as per the trading plan without any approval further required. Then mandatorily you have to follow the trading plan. You cannot stop it. Then if you are not implementing the trading plan due to any reason like financial difficulty or some other reason, then you have to intimate the complaints officer within 2 working days. So you are having the date, last date to do the trade as per the trading plan is 20th. Within 2 working days from that date, you have to inform this non-implementation to the complaints officer. You did not do the trade as per the trading plan. Inform it to the complaints officer. After that, the complaints officer will place such information to the audit committee. They will tell it to the audit committee. The audit committee will make a decision whether you are doing it in genuinely because of any genuine reason or you are doing it for malpractice. That will be decided by the audit committee. The audit committee will make the decision. After that, after making the decision, the decision will be notified by the compliance officer to the stock exchange. So the compliance officer will tell the decision to the stock exchange. Then whatever the actions that will be taken as per the code of conduct. Every company will have a code of conduct relating to the insider information. As per that, they will take the disciplinary action or any action. Then the compliance officer can approve the plan or reject the plan. That is the decision of the compliance officer, the trading plan. Now, insider, when you're doing the trading, you should give the information. Like, if you are an insider, you should give the disclosure of whatever the trading done by you. So that such disclosure should be in such form, such manner as may be prescribed. Those points are there. Then the disclosure that you have given, that will be given to the company only, and the company should maintain for a period of 5 years. This is important. This point is important. Then remaining point you can read it. There is no problem. Then disclosure by certain person. When you are appointed as a KMP or a director, or you are becoming a promoter, or you are becoming a member of the promoter group, then you have to make a disclosure of whatever the shareholding of whatever the shareholding that you are maintaining, that you have to give a disclosure. This is a one-time disclosure. Second thing is continual disclosure. Every promoter, member of the promoter group, designated person, and director, everyone should disclose how much securities they have traded. They will be normally trading. When they are trading, they have to do the disclosure. When they have to do the disclosure when the value of the trade exceeds 10 lakh rupees. When the value of the trade exceeds 10 lakh rupees, the value becomes more than 10 lakh, then they have to do the disclosure within 2 trading days. Within 2 trading days, you have to do the disclosure. That point you can find it here. Within 2 trading days, you have to do the disclosure when the traded value becomes more than 10 lakh rupees, in excess of 10 lakh rupees. Then the company will inform it to the stock exchange. The person who traded, he will inform it to the company. The company will inform it to the stock exchange. After that, the time for disclosure, everything will be prescribed. Then other connected person. Now we are having one listed company. For example, we can take they are having a listed company and they are having a lot of employees, and then they are having a lot of CEO, CFO, those people are there. Now the listed company has the power to get the disclosure from these people. These people are insider, connected person. These people should give the disclosure that whatever the trading they did, what are their holdings of the shares, that all should be disclosed. The listed company has the power to get the disclosure from these connected person. So that also they have given. For the purpose of this regulation, whether they are doing the trading properly, whether they are using the insider information, that we have to check. For that, the listed company can demand the information, can demand the disclosure from the connected person. Then some person, for example, you are there, you are not connected with any company, but you got the information. You got the information that some person, like CEO of the listed company, he is doing an insider trading. Insider trade. Like that, you got some information. Now you have to inform this information to SEBI so that they will take the appropriate action and do the investigation. So for that also we are having one provision. Original information in voluntary information disclosure form. So you have to give the information in the voluntary information disclosure form. You have to give the information under the informant protection office. There will be a separate office for this. You will be informing the details. For that, you have to give it in the form in the manner of Schedule D. The manner and then the form, everything given in Schedule D, you have to fill that form. You have to give the information to the SEBI. You have to submit it to the legal representative. If you are not using the legal representative, you have to come in person and then you have to give the form. Then in the form in which you are giving, your details should not be there because you are an informant. If the company gets to know or the CEO gets to know, he will do something. So you have to expunge the details. You have to delete all the details. You have to erase all the details. The form you are giving, right, in that your personal details, your identification details should not be there. So that point they have given here. This is a normal point only. You can read it by yourself. Just I have given the explanation, the context. The next thing, code of fair disclosure. Every company board of directors, they have to create a code of fair disclosure. So code of fair disclosure means UPSA we are having. For what purpose we can disclose it. For what purpose we can disclose it, and for what purpose we should not disclose it. That should be as part of the code of fair disclosure. That all will be created by the board of directors. It will be published in the website of the company. So that code, it will be properly amended, and whatever the amendment you are doing, you should give it to the stock exchange. You should intimate it to the stock exchange. Then in this code of fair disclosure only, we will have the policy for legitimate purpose. We saw that we need to create a policy for legitimate purpose. What are all the legitimate purpose? For that, that policy will be under the code of fair disclosure only. Then code of conduct. Every listed company and then every intermediary, and they should maintain that whether their CEO, their managing director, whether they are creating a proper code of conduct to regulate, monitor, and report the trading by the proper persons. So you will have some designated persons, like these people are insider, these people are connected person, these people are very important and they may have a UPSI. So for those people, whatever the trading they are doing, whatever the shareholding they are having, that we should properly monitor. So for that monitoring, we need a code of conduct. That code of conduct will be prepared by the CEO or the managing director. So we saw that what is the code of conduct? It will be prepared by the CEO or the MD of the company. The board of directors should ensure that the CEO or MD is properly creating the code of conduct. Then that we are having the normal information only. Relating to that, some information they have given, you can read by yourself. This is the concept of code of conduct. Then the designated persons. Who are the designated persons? Why we are creating the code of conduct? We are going to monitor the trading done by the designated persons. Who are the designated persons? For that only we are having the information here. Employees of material subsidiaries, promoter of the listed company, CEO, employees two level below the CEO. CEO is there, below him one level, below him second level. All these employees here along with the CEO, they will be treated as designated person. We will monitor the share trading done by these people. We will check them whether they are using the insider information to do the trade. Any support staff like IT staff, those people also, if they are having the access of the UPSI, then they will also be considered as a designated person. We will monitor the share trading done by these persons. Monitoring the share trading means we will see whether they are doing trading based on UPSI. Then penalty under section 15G. So if you are doing insider trading, we already saw under the SEBI Act 1992 that under section 15G we are having the penalty. Minimum will be 10 lakh, maximum will be 25 crore or 3 times of the profits made, whichever is higher. So this is a very important penalty. They might ask you in the exam. So this penalty you have to mandatorily remember. So that's all about the insider trading regulations. Now I will show you some charts. So here if you see, insider, connected person having UPSI, person having access to UPSI, they will be treated as an insider. A person when he is doing the trade, when he is having the UPSI, it will be assumed that he was motivated by the knowledge of such information. Then next point, when you see the procurement of UPSI, no person should procure the UPSI for the companies which are listed or proposed to be listed. Then insider should not communicate the UPSI, should not provide the UPSI, should not provide access to the UPSI. That is procuring UPSI and communicating the UPSI. Communicating, they can directly communicate, or they can give the document, or they can provide the access. They can allow them to see the UPSI. That also will come under communication only. Then any person should not procure UPSI, should not cause the communication of UPSI. Then UPSI can be communicated for legitimate purpose, performance of duty, discharge of legal obligation. Then here when you see, we are having one more chart. When the person is receiving the UPSI for some transaction like open offer or some other transaction, they are receiving the UPSI. They have to execute the confidentiality agreement. Then the parties, both the parties should keep the UPSI confidential. Whatever the parties that are there, the other party other than the company. So on one side company will be there, on the other side other party will be there. These two people will do the transaction. For that only we are communicating the UPSI. So the other party should keep it confidential. He should not trade. The other party should not do the trading when they are having the UPSI. Then structured digital database, the maintenance, it should be maintained by the board of director or the heads of the organization. They have to ensure, the board of director or heads of the organization, they are having the responsibility to check whether the structured digital database is properly maintained or not. Then content, the nature of the UPSI will be recorded, names of the person will be recorded, PAN number or any other unique ID of the persons will be recorded. The security, the structured digital database, it should not be outsourced to any other person. You should keep it internally. Then preservation, you should keep it for minimum 8 years. Then if any investigation is being done, you have to maintain the data till the completion of the investigation, till the end of the investigation, or 8 years, whichever is later you can say. 8 years even if it completes, currently you are going under investigation, you have to maintain the data till the end of the investigation. You should not erase the data just because 8 years completed. You should wait for the investigation completion. So that's all about the insider trading regulations. We have completed everything in the insider trading. So we have seen everything. Now that's all about the insider trading regulations. Now we have completed the topic successfully and we have reached the end of this video. So that's all about this chapter. We have completed it fully. We have done the full coverage and I have also given you the important points. Wherever they are asking the questions, I have also mentioned it along with the explanation. So that's all for this video. If you found this video helpful, share this to your friends, subscribe to the YouTube channel, like this video and leave a comment whether you like it or not, what are the suggestions that you can tell, and what are all the things that you are having the doubt, and what topics for which you need the next videos. That also you can mention it in the comments. I will try to make videos for those also. So all the best for your exams. Prepare well. Thank you.